everyone. Hi Isaac. Maybe we can give the team like 5 minutes or so to join, then you can start us off.
All right. Thank you, Grace, and good evening to everyone on the call, or good afternoon, the evening here in East Africa, but good afternoon or good morning from wherever you're joining us from. Welcome to this webinar. Our main topic of discussion today is listed alternatives and the evolution of African capital markets. As our markets really continue to grow and evolve, regulators, exchanges, and investors are looking for innovating ways to deepen liquidity, diversify opportunities. And I think this conversation comes at the right time. It's very important for us to have. We will be discussing more of that, the role of listed alternatives, market liquidity, investor participation, regulation, cross-border opportunities, and the like. And today we have Mr. Ngatia Kirungie from Spearhead Africa and Mr. Justus Ogalo from the Nairobi Securities Exchange. Isaac Kayemba is my name from the Uganda Securities Exchange, and I'll be your moderator for today. But I think to kickstart us off, in the interest of time, I'll ask Mr. Ngatia, to introduce himself first, and then we'll proceed to Mr. Justus, and we will have our discussion start after that. Thank you.
Thank you, Isaac. Good evening, everyone. My name is Ngatia Kirungie. I am the Chief Executive Officer of Spearhead Africa Asset Management, which is a Nairobi-based asset manager that's focused on alternatives, which we're here to discuss. We are also the promoter of the Spearhead Africa Infrastructure Fund, which is the first locally regulated and listed infrastructure debt fund of its nature in the region. I'm really happy to be here. Thank you.
Right. Good evening, everyone. My name is Justus Ogalo. I'm the manager of the derivatives market at the Nairobi Securities Exchange, also dealing with structured products such as ETFs that we bring to the market. As you may be aware, the Nairobi Securities Exchange is the premier capital markets exchange in Kenya, covering several different asset classes from equities, bonds, and as we're here to discuss today, our other alternative assets and other alternative products. So looking forward to engaging with the CFA members. And thank you, Isaac.
All right. Thank you, Justus. Thank you, Ngatia. I think we now know who we are going to be speaking to, but I think it's important for us now to understand what their thoughts are, what they're here to share with us, and more information from what they've just picked on. But I think to start us off, in your own words, how would you describe alternative investments? And just as importantly, which of these currently actually exist or are listed on African exchanges? And walk us through the typical examples that you work with on a regular basis so that our audience can understand what the landscape looks like for Africa at the moment. Over to you, Ngatia.
Thank you, Isaac, once again. Alternative assets are, simply put, they're asset classes that are outside the traditional listed or publicly listed equities and bonds. So we're looking at asset classes such as infrastructure, private credit, private equity, real estate, which we're all very familiar with. And these all historically have been uncorrelated to the public markets. And when we think about listed alternatives, that means wrapping those assets in exchange traded vehicles like REITs, and more recently, in our case, infrastructure debt funds like ours. The main reason, we've seen a big shift or a big growing interest in alternatives, and that's really being driven by diversification, where investors are looking to get more exposure than what they, more to get exposure to more asset classes than just the typical government bonds and a handful of equities, as is currently the case. And so that's driving the demand for alternatives in general, but listed ones specifically because they have that added advantage of being tradable and avoiding some of the pitfalls or some of the areas of concern, such as long lockup periods that we typically find with other alternative assets.
Yeah, I think just to add on that, uh, these alternative products tend to be structured to resolve a specific problem. When we look at traditional, capital raising from, selling stock or issuing bonds, then this financing hits the company, and the companies or sovereign that are actually raising that capital are really free to do what is required of them. But when we're looking at more alternative products, we're looking at products that are structured and listed with the design to solve pre-identified problem or a very specific issue within a company or an economy. So even from the perspective of the Nairobi Securities Exchange, then we do have several what we call alternative products that are listed on our exchange. Naturally, based on my introduction, I have a bias towards derivatives. So, for example, being derivatives which are non-traditional in sense, but are designed to solve a specific problem within the market. They allow investors to be able to speculate with different levels of leverage, so in giving enhanced returns or enhanced risk. At the same time, they're also there to help markets solve the issues of volatility. Then, on the other aspect, on the other side of it, we have products such as real estate investment trusts that are designed to give exposure to real estate products without, owning the physical underlying. So then it allows people to be able to invest in real estate without the encumbrances of having issues to do with liquidity, being able to sell or move the assets around. We also have exchange traded funds or ETFs that are tailored then to provide investors with exposure to a particular asset or a particular asset group that they may not organically have access to. For example, we have a gold-linked ETF that's listed on our exchange. So typically, to buy gold or to invest in gold can be quite a cumbersome process, literally, because you'd actually be holding, the physical assets. Then you have to deal with issues like security. So ETFs provide investors rather with an avenue to be able to invest in things that they typically would not have, and at a more effective and efficient manner through the exchange.
All right. Thank you, Justus, for that rundown. And always, I think I'll have to intermittently switch off my camera. But I think to proceed, really, the broader picture, I think you mentioned a couple of products that exist from a Nairobi Securities Exchange perspective. Where would listed alternatives sit in the broader East African capital markets picture right now? Is it out of curiosity? Is it something that is it genuinely becoming a part of our mainstream investment vehicles? And how would you really characterize the pace of adoption from the exchange's perspective?
So I'd say the short answer is yes, they're becoming a lot more of a mainstream tool that investors have access to. It's a rapidly growing sector. I think one of the main drivers of that is one, the need for, diversification. So in the Kenyan context, there's only so much you can actually invest or pump into, government securities or the existing listed companies, or cash deposits. There's, I think, a very big need to diversify. So we are seeing a lot more allocation towards a very big appetite for alternative products. Looking at just the track record we have over the last 2 years as the exchange, in terms of unlocking some of that capital, we've seen several corporates issuing, sustainability-linked products to the market, and the uptake is quite significant. I think in the last 2 years, all the products have been well oversubscribed. So I think the market is getting to a point where there's need for diversification and just offering more opportunities away from the traditional investment. So I think it is definitely becoming a lot more mainstream. We're definitely going to be seeing a lot more allocation of capital towards these alternative products. Because the nature of what they do, sometimes, it's just the simple fact that they align with the objectives of the different investors and different investor categories. So definitely, I think it's going to become more and more mainstream. Uh, I think even if looking at some of the special funds that we have in the market, we are seeing a lot more retail investment channeled towards some of these special funds that we have in the market. So again, the appetite is there. The capital is already flowing towards these alternative assets. So that's, I think, where we are and where we are heading. I think it's going to be much deeper.
If I can add, we are certainly, sorry.
No worries. Please proceed.
All right. So I think we are certainly at an inflection point. If you think back a decade ago, I think there was only a single REIT at the time, whereas today we have multiple REITs and multiple, other instruments that are, a clear proof point that, especially when you think about regulatory frameworks and the regulatory backing, that one is unmistakably mainstream. With alternatives in general, the capital is starting to respond. Not as fast as we'd like, but the listing will allow for that scale that is needed. And, as much as I'm saying it's not as fast as we'd like, the pace is actually accelerating as investors, like Justus has said, diversify out of their traditional holdings into more productive, long duration assets like property and infrastructure.
All right. Thank you, Ngatia. And to proceed with you, what do you think is really driving this timing? Why now? Why are we having this conversation more and more? Why is it becoming more mainstream?
Well, for one thing, regional institutional assets are growing and have grown substantially. And as you'll hear Justus and I say over and over, they remain overwhelmingly concentrated in government securities and a handful of equities. If I speak about infrastructure specifically, which is our area of expertise, the infrastructure financing opportunity in our region is large. And what you'd think would be the traditional sources of finance, being the banks, they really aren't set up, or their balance sheets aren't built to carry 10, 15-year long tenors that are required for this type of these types of assets. And so that leaves the capital markets as the natural next financier of scale. This is not unique to us. You find in more developed markets that you have a lot more issuers, you have a lot more capital raising that's done in the markets rather than reliance on the banks. Also, I mentioned regulatory frameworks. Those have certainly matured. In our case, in Kenya, we have the Capital Markets Authority and the Nairobi Securities Exchange that have spent years building the collective investment scheme, REIT, and infrastructure fund frameworks that made a listing like ours possible today. And then at the same time, you also have external factors. In the past, you would have financing from donors and development finance institutions who are now changing their focus to domestic capital mobilization. And so they have moved from actually financing these transactions themselves to doing all they can to essentially catalyze local investment into the same. So you have a lot of tailwinds that are that are working in the favor of listed alternatives right now.
All right. Maybe to just continue with yourself from a product design standpoint, and given your experience, with really Kenya's first listed infrastructure fund. What does it actually take? I think you've mentioned the part about banks. They might not be willing to have capital locked up for 10 to 15 years. Um, why look at an exchange, and what had to be true structurally when you're structuring this fund for that listing in particular to work?
Well, I can start off by saying that the main aim of listing was to disaggregate the credit risk, which is where our returns are derived from. Yeah, we are lenders, so we take credit risk, but to disaggregate that from liquidity concerns, which is a very big reason why institutions and as well as individuals have stayed clear of asset classes such as infrastructure. Typically, the offering has been the typical traditional private equity, private debt type structure where your capital is locked up for 10, 15 years in many cases, and that just is not very attractive or appealing to investors that are getting into this asset class for the first time. So by listing, you're able to provide liquidity at the unit level, even though the underlying loans that we are providing are they themselves long dated and illiquid. So the other factor that was necessary is a strong regulatory framework I've mentioned, as well as a well understood and very strong governance structure. So in our case, we pursued the Capital Markets Authority licensing as well as NSE listing, and that was specifically to satisfy investor demands for this type of governance frameworks, which will make them comfortable to invest into an area that is new to them, rather than them just sitting on what they already hold, which is government bonds. And I think importantly, before coming to the market, we had to be able to demonstrate credibility. And so having strong anchors, in our case, we had the CPF group as our local anchor, as well as DFI validation in the form of investment from the Mobilis program, which is part of the UK FCDO. And so we had to have that in place before you see broader institutional and retail access and investor following on.
All right, thank you for that, and maybe to continue with Justus, this to continue with Justus, that particular process from an exchange's perspective, and maybe in a way, the regulatory perspective. What is your experience, and how did you deal with Spearhead Africa and getting their product onto the market? And the first couple of days, run us through that, and the reception from the market, really.
Okay, thank you for that. Although I was maybe not directly involved with the Spearhead transaction, I think the journey for most issuers is still pretty much the same, even looking at alternatives. The first thing is always to just define what's the outcome that is being expected, or what is the issue that's trying to be resolved. Then we work together with the issuers to be able to understand what is then the correct vehicle or the right vehicle that allows you to be able to achieve that level of efficiency that you're trying to achieve with your objective. There's often a lot of a bit of back and forth and dialogue just to be able to understand, the nitty-gritty details of what is required to list this kind of instruments, and maybe to align the correct vehicle with, again, the regulatory side of it. However, I think, as Ngatia has also said, there is also a bit of, especially when it comes to alternative products, there's always a bit of flexibility required on both ends, even from the issuers, the regulator, and the exchange side of it, to be able to understand how to effectively get this product to market, while also maintaining, the fiduciary responsibility of all parties, that the investors must always be protected. I think also looking at it, what we have also seen of late is especially when it comes to that flexibility from ourselves and the regulator, is to be able to allow some of these products to come to market, because you can, and it's something that we've seen before with some of the other products that we have, when the rules and regulations are in place before a product has any proof of concept, then you're already creating, very strong barriers to entry for these products. So sometimes we have to look at it the other way around, is then how do we enable more alternative products and more, just generally more products to come to the market that have appetite from investors and are sorting out investors' needs. And then, in some cases, we have actually, yes, revised some of the trading rules to be able to accommodate. With the new regulations, they have allowed us as the exchange to create, new boards that accommodate different types of products, because you can't have rules for one size fits all. You can't regulate an alternative product the same way you'd regulate or have rules for a vanilla product. That can't work. So having a tailored framework towards some of these new products, I think has also been very helpful. And maybe for those who are considering, those part of the webinar who are considering, trying to figure out a product that you could bring to market, then it's always worth having a conversation. I know even our regulators are also very open to understanding which parts of the regulations may not make sense or are barriers to entry, and we work backwards to be able to solve such hindrances to the market and make it liquid and vibrant for everyone.
All right, and thank you for that. And to continue with you still, same issue around building genuine investor understanding and trust in products like these. Please just give us a run through of those that are currently listed on the exchange, that is Nairobi. How are they working? How are they faring? And is it really the job of the exchange or the regulators to ascertain that investors understand these products, or is it an issue as role? I think this is later on we'll have that perspective from Ngatia too. But how is this handled? Whose role is it really?
The short answer is it's everyone's role, all the way from the regulator, the exchange, and even the intermediaries. It's everyone's role in terms of education at different, levels or at different needs. So as the regulator, they would want to, ensure that investors are fully aware of, the products that are available in the market, what they mean, the differences to them. From the point of view that, they'd want to, protect the investors and ensure that the investors have a good understanding of basically what they are getting into. From the exchange point of view, we are also very big and keen on investor education and building that knowledge base, because again, we then are in charge of, the whole, the marketplace. So we have to ensure that anyone who's coming to invest in the market has a good understanding of it. Then we have the intermediaries who, from the commercial point of view, part of the sales role is to onboard new clients and to get in those transactions into the market. They need to make the clients aware, or the investors aware, of the existence of these products, the benefits of these products, such that they can then, properly take them up. I think all sides of the market have to do this together, and in one voice, more or less, to be able to actually achieve this. And I think we've seen it with some of the products that we have listed in the market. I think there were some very big learning lessons, because, even as the exchange, when we have learning lessons, we don't sit back. We actually use that information to then evolve our market and do better. Across the different products. If you look at some of the structural changes that we have actually implemented as the exchange in the last, let's say, 2 years, as an example, then it can give you an indication. Sometime last year, we lowered the lot size for a single trade in the market from 100 to one share. Again, these were changes that we learned were hindrances to retail investors. Having retail investors in the market has driven significant liquidity to the market. So making such changes to be able to accommodate, excuse me, different the investors are some of those lessons that we've learned. On the REIT side. We had some REITs that were listed on our main investment market segment, but there was a lack of understanding of how REITs generally operate from retail investors. So that led it to being delisted and listed on our unquoted market segment. Again, those are some learnings that we've had. And because of some of those proofs of concepts or from those products, then new issuers are able to adapt to some of those changes. On our derivatives market, similarly, we also reduced the contract sizes to make this product more palatable for retail investors, who, as it turns out, for the last 7 years since we launched the product, the market has been largely retail dominated. When we made such changes, then now we are seeing improved performance from the market. So in a nutshell, yes, investor education is every professional in the capital markets job. And yeah, learning the lessons helps us evolve and develop the market and makes it, friendly to all investor categories.
All right, thank you, Justus. And for Ngatia, really, is from an issuer perspective or a manager of such a fund, how do you go about really creating that form of investor understanding for your investors? The products themselves could be a little technical and harder for the retail investors to take part in, and yet, as Justus mentioned, a lot of these are actually being taken up by retail investors. How do you go about that investor education from an issuer's perspective?
I think there are two things. First of all, in our market, complexity is the enemy, right? Generally, no one is going to invest in what they don't understand. And so it is good business sense for you to ensure your strategy is simple, it's understandable, it makes sense even for non-experts. But further investor education is still key. And so in our case, what we've done is that we are understanding and we are patient that the first time investors hear about our product is not necessarily going to be the first time they deploy. And I think what you will find is that a manager's performance will really do a lot of the in education or marketing for them. You can go out and pitch on a theoretical strategy or a strategy that you haven't actually practically established or carried out. But the best form of education really is to show people actual performance. And so for our target, and for as long as we deliver the returns that we have promised to our investors, we keep the same strong governance structures that we have in place right now, and ensure that investor capital is protected, then you find that that kind of education, naturally builds out by itself without necessarily needing anything formal to be done. This point of investor education has been very important when we were thinking about over the last 10 years dealing with the local pension schemes. And what has happened is in the past the strategy has been conferences and similar type arrangements where you find that you bring everyone into a room, and for half a day you take them through the strategy and the likes, and at the end of that gathering, everyone has forgotten 3/4 of what you just told them. Yeah, so ensuring that you have a more patient approach, ensuring that you can actually show returns backed by that, we found to be the most effective way to go about that investor education.
Oh, perfect. Maybe just to follow on, I think same discussion, because it's really an important one, is from where you sit currently for the fund since you launched. Who really are the actual investors that are showing up? Is it pension funds, insurance, retail? And really, how would you convert generally if you're looking at a private capital fund, maybe you're looking at one that's listed, if it's a REIT or an ETF, how would you really convert these broadly um, institutional shareholder registers into a retail, or having just about democratizing that access? How would you go about that? But also, who, from your perspective, is showing up as an investor at this time?
First, I think in general, our local investors are not big participants in the private markets in general, right? So if you really want to tap, that pool of funding, the public markets are the way to go. And in our case, we had a pension scheme. We did have a DFI, as well as high net worth and retail individuals invest in our product. However, the first series, because we'll have multiple, was skewed institutional and DFI by design, so that we would signal to the market that the product was built to the highest institutional standards from day one. And converting that, signal into retail participation, again, I'll say it's all about proving your return and proving your performance. And then now, on top of the DFI institutional credibility that's already in place, you find now that retail participation will follow, because essentially you become de-risked to the larger market. So it's as simple as that, really. Investors, whether institutional, or retail, whether in the public or the private markets, are all looking for the same thing. They're looking for attractive risk-adjusted returns. And so we are able to demonstrate that, in our case, through infrastructure debt. And, again, going back to what I mentioned about the patients, once they have established that we do have the kind of returns that they are looking for, now it's just about ensuring that they always have the instrument that they can purchase and get exposure through, and hence the benefit of getting listed rather than staying private.
All right, and maybe speaking from a listed a perspective, listed, Justus, how, if you have an idea for these products, and especially derivatives at the moment, you mentioned retail investors, is it the same? Is it carried on to the REITs and the like, or do these instruments all have their own shareholder bases, or shareholders who are interested in them, or investors, if we can use that as a term of reference? Do they all have unique registers, or are you looking at institutional for some and retail for some, or is it balanced in a way?
It's a good question. I'd look at it from the other way around. It's the investor who determines what product is right for them. It's not even us as the exchange who determine what product is right for investors. So as you've also rightly pointed out, I think using the derivatives as an example, I think when the product was being developed more than 10 years ago, I think the thinking was that this product would be best suited for institutional investors. Now, granted that, yes, the big volumes would then become from institutional investors, I think what we've learned along the way is that the risk appetite for retail investors is significantly higher. So what we've observed over the last 6 years since we did launch the market is that retail investors have a much higher appetite for risk. And I think these are things that are also comparative in terms of some of the other products that are in the market, not necessarily under the exchange. If you look at how, for example, sports betting has grown, it's not from a lack of understanding from retail investors. They understand fully what they're getting into. So the appetite for different products comes from the investor, not necessarily from the exchange or the issuer. Similarly, looking at even REITs, we've seen some of the REITs that have been issued in the market were also, largely retail traded. Even the ETFs have also been retail traded. However, organically, there tends to be, one segment that would overtake the other. So as much as, yes, retail investors do have appetite for REITs, then you'd find the institutional players are more likely to take it up because also understanding the nuances of it and also the, return structure. So again, I think it depends on the product, but with each product that comes into the market, we don't necessarily target the investors. The investors choose which products that they want, and once you have that information, then you now come up with different strategies of how to engage all these different market segments at their own level. So the language you'd use to speak to a pension fund about a particular product is different from how you'd engage with retail investors about a particular product. Sticking with with derivatives, how the institutional investors have taken it up is as a risk management tool. How retail investors have taken it up is more for speculation. So again, it depends on the product and again the investment strategy for that particular investor and their categories.
All right. Thank you for that, Justus. And for the audience or members on the call, on the webinar, please share your questions, your comments in the chat. We will have those answered and discussed to the fullest extent later on. But please do share with us so that we can also have a very engaging discussion. Then next, I think for Justus, still with you, is on the secondary market. Really, what has to happen for investors to genuinely be able to trade in and out, and not just buy and hold, really from a secondary market perspective, and having that activity present for alternative investments, and for products that really show signs of underperformance. Is it something you attribute to pricing? Is it the structure itself? Because structuring the products can be a little complicated, and I think we'll get back to Ngatia to just give us a rundown on structuring these products and pricing them. And then lastly, is it investor education or liquidity? What really would you attribute an underperforming product to?
Thanks for that question. So in terms of trading, there are different aspects that we've seen again over the last 2 years as we've implemented our new strategy, just to drive more towards trading as opposed to buying and hold. And I think one of the key drivers in terms of investors trading in or trading in and out is once the returns have to match that activity, because if I'm buying a long term, maybe if I'm buying into an asset or an alternative asset, and the growth in terms of, let's say, even capital gains, since being a listed product, is very slow, then you won't see much trading activity. So the first thing, it has to be the quality of the assets, or that alternative asset that you are listing on the exchange. And of course, for that, we go through very good due diligence to be able to ensure that the right products are coming to the market. So performance of the asset, which then also drives volatility of that asset, because if the prices are not moving, or if there's no volatility for an asset, then you won't find investors trading in and out. So that has to be one of the things that needs to be addressed in the market. Secondly is also access. The more people we have in the market, the more investors were able to crowd into the market, means the more investors who are, pushing up prices in terms of demand, which then now organically leads to being able to trade in and out. So even as the exchange, we have, I think the most important part of our strategy between 2025 and 2029 is to onboard more investors to the market. Our actual number is 9 million active retail investors to come and, drive that market activity. Education also plays a big part of it because, again, investors really have to know what it is they are getting into. So through that, we have implemented, different strategies to provide that knowledge to the investors. Very recently, we did launch our simulated trading environment that gives young investors an opportunity to practically trade in the market, with virtual cash, but still have the experience of seeing a portfolio grow. And also understanding, which corporate actions would then drive the market, drive prices up or drive prices down. And also how then they can be able to react to the market. I think information in terms of market data, having access to that information plays a big part. So we do our best to disseminate as much information about products in the market as frequently as possible. And I think also cost also plays a big part because with lower cost or lower transactional costs, then that also then widens the available spreads for investors to take advantage. To the second part of your question, the short answer is yes, all of those items do play a part, but then again, they also tend to be product specific. I think when we looked at, let's say, our derivatives market, for example, investor education has played the biggest, I think, role in terms of what we could have done or are doing better, and we are seeing the impact of that playing in now. In terms of looking at the ETFs, we are looking for more ETFs to list in the market. So definitely, if there's anyone in the audience looking to be an issuer, then of course we can discuss. But with the ETFs, pricing has played a factor. One of our most successful ETFs in the market being the Absa New Gold, for the longest time had priced out a lot of investors from participating. When we did change the lot sizes last year, then we saw a lot more participation from retail investors. When we look at, the REITs, then we've seen issues in terms of policy to do with issues to deal with the tax and stamp duty that have been an hindrance from issuers bringing these products to market. So all these do play a very big role. It's just I think they are more product sensitive than a blanket issue in the market. We do work very, very closely with our regulators to be able to, adapt regulations and our trading rules internally where we've identified there's an issue that hinders the market. I think lastly, just to add on that, is even from our investors, we usually call for and we rely heavily on feedback. Because the only way we can then adapt our market or adapt the product, even if it's the pricing or structuring or policy from the policy side, the only way that we can then address market issues or hindrances to the market is when we receive that feedback. Otherwise, we'd be sitting in a bubble, assuming everything is okay, but it's not. So any feedback that we usually receive, that can enhance the market, enhance liquidity, then we are always very open to receiving that feedback.
All right. Thank you, Justus. And over to Ngatia to run us through pricing, structuring. How is it done so that both the primary market and secondary market are managed in a way to attract investors, but also maintain liquidity on the market, while also really promoting access to these products?
Our pricing is based off the net asset value of our underlying assets. As a debt fund, I mentioned that we're providing long-term loans, and calculating NAV is significantly easier or more or less complex when you're looking at a loan or a fixed income instrument than if you're looking at say equity, for example. And that speaks to what I mentioned earlier about complexity being the enemy. And so we're able to show investors, or investors are even able to calculate on their own, what is the value of the underlying of the assets that we're holding, at least on a very high level, which then now leads to let's call it minimum discrepancies around valuation or around pricing. But on top of that, we report that NAV on a monthly basis. We have independent evaluation of our assets as well. And when we look at the trading side on the secondary market, our instrument is priced again based on the NAV. And that was what Justus spoke to, what he alluded to about prior lessons learned. In the board where we are listed, it's called the Unquoted Securities Board. They were able to, instead of it just being straight demand supply price discovery, we are able to show the market this is the independently verified valuation based on an NAV basis, and then you can trade around a small band around that number. So that way we ensure that we don't find ourselves in a situation where you find that the fund is trading at a significantly lower price than the net asset value. So we're trying to keep we designed the product to be as simple as possible, and essentially to tie the band of trading to as close as possible to that net asset value, which is independently verified.
All right. Thank you for that. And next, I think just in connection to that, really, do you see credible flow, future issuers, yourselves, anyone else, especially around structured funds, infrastructure funds, green or sustainability linked instruments that are listed and trading on an exchange? They might not be in isolation, but are part of a fund. And what's really the constraint right now? Is it more products? Do you see it from an investor perspective, or is it regulation? And I think we'll come back to Justus. Quite a number of issuances on Nairobi Securities Exchange have been oversubscribed. So would we conclude that there is liquidity on the market and no products? And how do the alternatives come into support?
Yes. First of all, I think Justus would be a better place to talk about the pipeline. But anecdotally, I do think there is a credible pipeline because we've heard from a lot of issuers or a lot of institutions that want to issue what you're mentioning, these green and sustainability linked bonds or additional REITs in our market. And we've heard from them because they want to learn more about what our journey was. So anecdotally, yes, it sounds and it seems like there is a credible pipeline of new opportunities coming through. But I think the binding constraint today isn't regulatory. It isn't the issuers really. I think both have, there's been a lot of progress on regulations, and issuers need capital. I think the biggest constraints are product. So yes, you might need capital, but have you designed a product that that ticks the boxes for investors, not just for yourself. And that then speaks to investor appetite for these new asset classes, because investors need comparables to allocate in scale. Yeah, you need to be able to compare, two, three, four, five different alternative opportunities. Otherwise, if it's just one or two, then it looks very exotic and may seem more risky than it is. So having more issuers really just compounds confidence and benefits the next issuer, which then benefits the market as a whole.
All right, over to you, Justus. Really, the pipeline,
Yeah.
any future flow for alternative instruments in general. What are the constraints? And maybe just to add another, is it a product that Africa should be considering? I mean, given the nature of how slow our actual traditional assets tend to grow.
Definitely, yes. Let me start with your last question. Definitely, I feel there's a lot of opportunity for alternatives in Africa. I think in terms of number of listings, just broadly speaking, I think there is a bigger potential for the alternatives than there is for the traditional side. And with that said, if I look at some of our I guess, alternative listings over the last year or two. One thing that the numbers, the good thing, the numbers don't lie, is that there is liquidity for them. I don't think there's any issuer who has come to the market over the last 2 years, especially even on the alternative side or even on the vanilla side, who has not met, their target. So if I look at, Spearhead, for example, being, obvious example is one. We've seen yesterday, we had the terrific REIT being listed again, oversubscribed. We saw the Safaricom Green Bond oversubscribed. KMRC came to the market with a sustainability linked bond oversubscribed. Then we've also seen even the Sukuk side, the Islamic financing side, again, has also been able to raise significant capital. So if the last, I guess, 2 years are an indicator, then yes, there's a very, very big opportunity on the alternative side. Forward looking, I may not be able to speak to the specific transactions coming to the market, but as part of the NSE's strategy, which again is at least is public information, we did target to have 50 listed alternative products over the next, or rather over the period 2025 to 2029. Being a year and a half into our strategy, then you see we with some of the listed, with some of the products that I've just mentioned coming to market, then we have, even where we sit, we do see it as a very big opportunity for Kenya and also for the wider African market. I think there's a lot more potential in terms of opportunity on the alternative side than on the traditional or vanilla side.
All right, thank you for that. And any particular products you would think and not currently being considered on an alternative side that you think would be best placed to be considered? I think the ones that are being looked at mostly are those sustainability linked bonds or green bonds. I think infrastructure funds, ETFs and REITs. Any others? Especially around real assets. I know our African economy is still a lot in commodities. Is the commodities side one you think should be also heavily considered? And I think that's for you and Ngatia too.
I think if I can generally say, as the exchange, we consider everything because the markets are really what determine what products are brought, and I say that from the investor and the intermediary side. As the exchange, we sort of flow with the wind. Our role is to adjust the sails of the boat. Our work is primarily to facilitate, but we are seeing interest from all around. More specifically in Kenya, we've seen the growth of tokenization and digital assets on a global scale. We've recently had, I think late last year, we had the VASP Act that was put into place, and very soon we're expecting the VASP regulations to come into place, which then means that, the digital assets and tokenization space is something that we cannot afford not to look at, given its growth in the market. Infrastructure, again, is also another very big area. Even from the sovereign side and also on the private sector side, is another massively growing area. I think from the use cases I've just given, sustainability is also quite big. I definitely have a bias towards, derivatives markets, which is sort of my bread and butter. And for that, we recently also just introduced options to the market, just to, again, diversify the uptake for investors. So each category, I think, I don't think there's any asset class that we are not possibly considering. And we are actively definitely engaging with different market participants, different intermediaries, and different issuers to bring these kind of products to the market. I think maybe just to lastly mention, and I think I also touched on it at the beginning, is that the markets need to be market driven. Rather, the exchange and capital markets need to be market driven. They cannot be regulatory driven or exchange driven. So the demand for these products has to come from the market. So through that, then you need investors to point different market stakeholders in the direction where the capital is going to flow. We need more effort from the intermediaries in terms of structuring some of these unique products. I don't think there's a lack of capital in the market. I think even Ngatia had mentioned it earlier, is where what is the right product for these different market segments to be able to deploy that capital to.
All right. I think Justus has mentioned intermediaries are not the exchange moving the market. I think that sets the stage for you, Mr. Ngatia, to move us on in that direction. From an issuer standpoint, it might not be a product you have on your catalog at the moment, but what are those you think issuers should really consider given what you have as a read on the market at the moment?
I'll just echo what Justus said. It's probably not so much what the issuers want, because the need of for capital is required in just about every sector in our economy, and not all of those sectors are necessarily productive, or not all of those opportunities that need capital are necessarily productive. Maybe there are other areas I won't mention, but it's driven really by what the market wants. And the market in this side, I mean the investors. Because you can have failed issuances, and we do have failed issuances all the time. And that's not unique to our market, that's true in any market. So if you want to narrow the discussion to a successful product ticks the boxes that local investors or investors broadly are looking for. In our case, when we look at broadly, not speaking specifically about infrastructure, the first is a regulated product. Yeah. Especially when you're looking at a new asset class like alternatives, having the regulatory oversight is very powerful. It allows investors some form of confidence and comfort that their money is actually protected and there is strong oversight. Secondly, what we're talking about here today, which is listing. Listing allows the investors to risk manage for themselves, and so they can hold the instrument for 5 years if they wish, or 5 days. Yeah. So listing is very important. Um, Also, again, returns. These returns must be more compelling from a risk-adjusted perspective than what the investors would currently get right now. And in our case, majority of that is government bonds. So you have to have, it's very difficult to convince an investor of any sort, retail or institution, to put in their money into an asset class or a particular investment that is giving them lower than government bonds right now. Yes, we want diversification, but not just diversification for its own sake. So I think if you have those three elements aligned, I think you are further along the journey than previously. Yeah, where probably we probably just thought only of returns in isolation.
Right. Thank you so much. I think, Grace, I don't know if there are any questions in the chat that we could be missing, because I can't seem to see any at the moment. We have had quite an elaborate discussion, but if in case anyone on the call or listeners has any question, please post them to the chat. They will be answered. We'll have a discussion on those, and they will be very valuable. But I think to continue as we receive those, from a regional perspective, I think access to these products to the wider investor base in East Africa. I think some of the issuances on the traditional side have really been taken up by investors regionally. Find Ugandans investing in Kenyan government bonds, Tanzanian government bonds, government bonds from Rwanda. Well, we have quite a number of cross-listed entities across the region. The ETF in Dar es Salaam and on Dar es Salaam Stock Exchange has been taken up by quite a number of people from the region. From both your perspectives, really, is to understand regional strategy. How do we get investors from across the region to be a part of these instruments? I think over. Yes.
So I think there are a number of things, and we'll just take for granted that the instrument must be attractive to all investors first of all, right? But when I think about regional integration, first thing is regulatory. So an idea and what would be important would be to have mutual recognition of, say, fund licenses across the region. So if you're licensed or if your product is licensed by the CMA in Kenya, it is recognized by the CMA in Uganda and the equivalent in Tanzania, for example, so that one license in one jurisdiction, you can market or you can list without rerunning the entire approval process in every other market. Secondly, we think about market infrastructure. This is now where we're looking at, or where we would want to see greater integration in terms of linked trading and settlement. That will essentially allow investors in one market to hold and trade instruments in another market, or at least reduce that friction that is currently there. I think right now what you have is cross-listing. So you have one issuer on multiple markets. We'd like to see maybe going a step further beyond that, where there is a greater integration on the settlements and trading side, especially. And finally, it's the investment guidelines and regulations on pension schemes and insurance companies, for example, so that alternative investments in one market or alternative investments across all the markets would be viewed or would qualify as eligible assets everywhere. So, like, in Kenya, we have infrastructure as a distinct asset class in our regulations. So, pension schemes can invest into infrastructure directly, whereas in other markets, maybe infrastructure is not distinctly spelt out and would fall under another category, whether called other or otherwise. And harmonizing those regulations would be very powerful in that kind of regional integration that we hope to see in the near future.
All right. I think to sum it up for me is really mostly around regulation and harmonizing market infrastructure. But Justus, what would be your thoughts on that?
I think yes, generally agree with the principle of having, a sort of unified, a more unified East African market, in the sense that is harmonization of things like regulation, which I think a large number of that activity has already been undertaken. Having uh, looking at it from even just the trading side of it, I think there is room for the markets to be more connected, such that you can use a trading platform in Kenya and be able to access Uganda market or Tanzania market, and vice versa. I think um, those are some good innovations that I think the region needs. I think it's always just about also figuring out the logistics of it, in terms of how do you actually implement that, given that each jurisdiction has its own, I guess, agendas. But I believe some of those issues can be cured through the intermediaries. So, having one intermediary with a presence in, 3 or 4 different countries in the region can be able to provide such services to the different markets. I think one of the main, regulatory frameworks that enables that is that the investor category of an East African does enable such. So, you can be, you citizen in Uganda and be able to trade in assets on the exchange in Kenya, as long as, your intermediary facilitates you, and, it would be easy, it would be recognized as, an East African investor, and enjoyed some of the benefits. But yes, I think at the larger scale level, there does need to be a bit more harmonization in terms of the benefit of the issuers Ngatia had mentioned, and yeah, the distribution of the products would be a lot more seamless throughout the region.
All right. Thank you, Justus. Maybe to continue to Ngatia, some of these funds usually have life cycles. A fund running for 10 years, for example, especially on the private capital side. But for funds like infrastructure funds, maybe you have tenors of instruments that are going to expire at a particular point in time. How do you, from your perspective, manage that revolution? One fund is expiring into another, and how would investors, from your perspective, look at that, especially from a continuity perspective? Because if I was, for example, an investor in Safaricom, maybe my core understanding is Safaricom is going to be around for a while. I'm investing for the long haul, and I don't have a hard stop or a deadline on that. How would you manage, especially given the long-term nature of some of the investors? How would you manage that revolution?
Yeah, that's exactly why we went this collective investment scheme structure, this unit structure or unit trust structure, and listed. So our fund is a permanent capital vehicle. And so by listing, if anyone needs their money back, they can trade those units at any time, including indefinitely. So if you find that the investment is working for you, you won't have a situation where in 5 years' time I'm returning your capital back to you and then essentially asking for it back for a new strategy. No. You can trade out at any point, or you can just stay in indefinitely. It's to achieve just what you have mentioned, Isaac. Um, so that's where the structuring is key. What we found the traditional method was you have fund one, fund two, fund three, and so fund one, or not just fund one, all the funds will have their investment period, or you'll have your capital raising period, and then once you have raised that capital, once you have reached that point in time, you stop and you deploy what you have. Um, Whereas that might work in markets where in that capital raising period you can reach scale. So like if you have 1 year or 2 years, you can hit the X billions of dollars or shillings that you wish, that's fine. But in our market where we are uh, understandably conservative, it was important to not have that kind of constraint, right? So for us, we are constantly raising and we are constantly deploying. And so investors are, we're not just talking to investors at one point in time. We are with them, every day of the week. We are talking to them all the time, and we are returning investor capital in the form of interest payments and interest distributions every quarter as well.
All right, perfect. And Justus, really, from your perspective, I think Ngatia has mentioned something about collective investment schemes. These seem to be thriving, both from an unlisted perspective, but also listed in regards to ETFs. And I do see or hear, maybe you can explain further the concept of Chama in Kenya, really getting together to form such kind of alternative investment vehicles. Is it the route we have chosen to take as East Africans, and as a nuance, really, how is it supporting the growth of our markets from your perspective?
I think yes, it has helped the growth of our markets. I think there's one thing that even through the Chama model is, let's pool our funds and use that collective knowledge or hand it over to somebody who does have the knowledge to be able to invest on our behalf. So definitely, um, I think these funds have grown, or the CISs have definitely grown because of the need for passive income from the investors. So we find, um, looking at the special funds, for example, I think a lot of the retail investors who have participated in these funds have been attracted by the returns. So the returns are very attractive, and through that is when they start to get exposure to some of these, a more what would considered, a risky product. But it is the ability of these investor groups to understand that, okay, I don't know how to invest these funds. Let me hand over my money to somebody who does, who are the industry professions, who are the CISs, and the different fund managers. Once their goals are aligned with that of the fund manager, is then then they're able to actually pick which fund manager to go to. So if I want, some exposure to infrastructure, but I don't know how to do it, definitely I'm going to reach out to Ngatia. If there's another fund that has exposure to, or rather, I want exposure to, the commodity space in other markets, then and align myself to the fund manager who's able to offer me that kind of product. So I hadn't previously not looked at it from the Chama perspective, but now that you asked it, then I think it does make sense that even as it sort of stems within the African culture, that we can invest collectively and definitely then enjoy the benefits of scale. So with CISs, they're able to enjoy different benefits such as cost of trading is lower. The cost of due diligence is also significantly lower. So then when we are all investing together through these CISs, then it becomes a more efficient tool for us to deploy capital. As the CISs, then they are also able to make effective investment decisions that then translate to, liquidity in the market. Because if the fund manager is able to ascertain that, this particular asset, actually do their due diligence and determine that this particular asset is going to provide the returns that their underlying clients want, then they'd be able to channel the funds through that, which then breeds, liquidity on its own. So the bigger the CIS industry grows, then we find the more liquid a lot more of our products become in the market. Again, the numbers even in Kenya tell a good story of that. I think over the last 4 or 5 years, we've seen significant growth in the CISs. That also then correlates to the growth, we are also seeing on the exchange side of it, on the ability of new issuers to raise capital for these alternative products and for traditional products as well.
All right, and I think still on that same point, Ngatia, is transitioning these type of alternative instruments because they tend to have a real asset backing them up, or they are built of other instruments or other assets. Do you see any form of transition from such models? Maybe if you had a collective fund that is investing in different companies, transitioning them off to, let's say, a single bond instrument directed to a company, or vanilla in a way, or an equity listing, and just transition, forming that form of transition and continuity, so that maybe the fund creates an asset that is then off the market. So having access to it is a little more complicated. How do you see that pipeline, and how can we create models that achieve that? Is it feasible? Is it something that should be pursued? So generally, just run us through that from your perspective.
Isaac, I'll ask you to please just repeat that because I didn't fully get the question.
Sorry, it's kind of so many in one, but I think it will also form part of our conclusion today, is really generally transitioning. When these funds are created, you're investing in something. Maybe that something becomes a real asset. And is there any point where it stops being collectively owned by a group and off the markets? And how do you manage forever? For example, you created some form of infrastructure fund for your perspective, invested in an asset or a company. Does that company go on to issue more securities on the market, and is it a form of development really for the capital markets in general?
Well, in our case, we are providing debt, so we are not looking to take equity ownership of these opportunities. Yeah, in these opportunities. So, for us, the strategy is very clear. We are we're investing at the very top of the capital structure, which is the most predictable and the safest. So that's not going to be an area for us directly, but in theory, or when we see actually not in theory, in practice, what we find is what we find to be true is these private equity type investors. They will find great assets. They will hold those assets. They will build those assets. And then the challenge comes in exiting, right? Uh, so you still have that asset, but transitioning it out of the fund to another buyer or to the public markets, that hasn't happened as often as people would have hoped, or as often as people would have hoped when these funds were being marketed to them. And that's for a number of reasons. The first is that there are just a limited number of buyers of these assets out there, especially if you're trying to sell them, as a whole. So that one is tough. And so the solution to that is to, either list them or to make those assets themselves, or to make the ownership in those assets themselves unitized, so that you can sell a portion, however small, to a large number of investors. That could help. But you find that this, what you're calling the transition, is a big challenge for the traditional fund managers in the traditional LP, GP fund structures out there.
All right, thank you. We don't have any questions in the chat. I hope we had a very elaborate discussion, very educative discussion. We can have some parting shots from you, Ngatia, and then Justus, and then we can see how to close this off.
For me, mine is just to reiterate that it's important to meet investors where they are rather than where you think they should be. And our investor base currently looks with favor on listed instruments. And so the use of listed instruments, or the use of the capital markets, especially when you're thinking about alternatives, is important. And we only see that becoming, stronger. Thank you.
Over to you, Justus.
Yeah, thank you. I think for me, as maybe you've seen from my line of work, um, I sort of found vanilla products a bit boring. So, I dedicated my time and career into this alternative space, landing in the derivative side. So I think it's just to, just emphasize the massive opportunities that are available within the alternative space, both existing products and some that we've not even thought of yet. I think there's a lot of opportunity within this side of the market. So it's just to encourage everyone that, we can put our theoretical knowledge or our textbook knowledge that we've gained from, programs such as the CFA itself into practice. So there's a lot of opportunity. It just takes, one or two to, be the first one to dip their toes into the pool. As Ngatia mentioned earlier, he was the first to dip his toes into his segment, and definitely we will see more and more similar products coming to the market. So I think it's just to encourage everyone that this space is very free and flexible. So just dip your toes in the markets. If you have a product that you'd like to structure, I don't think there's anyone in the capital markets who's predisposed to saying no to any sort of new idea and to listing or creating any product within the market that actually does, meet, any investor's goals. So I think that's just my word of encouragement, and to thank you and the CFA team for inviting us for this. Thank you.
All right, thank you, Ngatia, Justus. It's been a pleasure having you. from me, at least a lot to learn for a region in general, and look forward to having more discussions with you. Thank you, and over to you, Grace.
Thank you so much. I think this is my first webinar where there have been no questions. I think you were very elaborate in your answers and guys understood what you were talking about. So thank you so much, Isaac from USC. Thank you, Justus from NSC. And thank you, Ngatia from Spearhead. We really appreciate your time speaking with us today and teaching us more about the alternatives market. Clearly, I think when, what is good name? Warren Buffett said, if you can't make money while you're sleeping, then you're really not yet, you're going to work until you die, meaning really money is not working for you. And I think that's the statement that comes to mind every time we're talking about alternatives and every time we're talking about the capital markets, that you need money to work for you, not necessarily you working for the money. So thank you so much. Even to NSC for the partnership. Thank you for giving us the virtual trading platform. I think I'll still go ahead and insist to the CFA team, if you're yet to log in to the virtual platform that NSC has created for us, please do so as they work around ensuring that the East African markets can still come on board and practice there virtually as before they enter to the Kenyan market, with real money. And I think maybe Isaac, my challenge to USC is for you guys to also create for us a virtual trading platform so that we can be able to come and trade to the Uganda Securities Exchange before we dip our funds there, the real money for it. So thank you so much. We look forward to hosting everyone on the 15th of July for the Alternative Investment Conference in Kampala. Reach out to us in case you haven't gotten the information of how to do your bookings, both flight and accommodation. We are glad to send that your way. We do definitely have complimentary tickets for various teams. So get to speak to us and find out if you're among the lucky teams to be able to access that. But of course, like always, CFA Society is out to ensure that you're making money or money is making actually you're making money or money is working for you. Both of those two statements stand true because we've brought you the NSC trading platform webinar. We've brought you this platform, this webinar to, talk to you about trading on the alternatives market. Do not fear. Reach out to us in case you're not sure. We'll definitely hook you up with the NSC expertise. And Justus is really proud of the alternatives market and not the vanilla market. So definitely we do have people who are experts and can help you. And like they've said, if you are a manager of a fund and you want to be able to list there, so feel free to reach out to us. We are able to make that connect for you. Otherwise, from us to you, enjoy your evening and see you on the next learning webinar. If not, see you on during the conference.